Bond, congratulations once again on a well-earned Lifetime Achievement Award. Now, in a very sad reminder of just how much Bond has slowed down after his lifetime of achievement, Adams Street Partners guided only 3 portfolio companies to IPOs on successive days last week. I'm sure in Bond's prime it would have been 4, easy, maybe 5, but it was 3. The companies were Paylocity, which priced on Tuesday, Q2, which priced on Wednesday, and on Thursday, Border-Free. Congratulations on that achievement as well, Bond. And I wonder if you wouldn't mind picking one of those 3, maybe the one you're most excited about it as a game-changing, world-changing company, and tell us a little about it.
There's probably a prohibition on my talking about that, but it was a lot of hard work and obviously luck, because some of the companies have been in our portfolio Border-Free in Q2 since the early 2000s. Border-Free is a cloud-based service that helps with foreign exchange and e-commerce marketing transactions. Struggled in its early days and did a pivot and found a spot within that sphere that worked very well. So it's one of a classic venture capital stories where it was written down probably to 50 cents on the dollar, and now it's trading more than 10x our cost. Started in Israel and headquartered here in New York. On a great trajectory with a great management team. Nice. Paylocity is an Arlington Heights, Illinois company. We're the only venture investor in that, and that's a cloud-based system for payroll processing and so forth, and it's growing like a weed, and we have 36% ownership in that before the IPO.
And it's a nice reminder. Most people think of Adams Street Partners as a fund-of-funds firm, an advisory shop, but you are very active as a venture capital investor.
We are. In our history as a fund of funds is actually backwards from all of our competitors, and we started doing direct investing first and did that for 7 years before we got into the so-called fund of funds business. Our direct activity started in 42 years ago, in 1972. We were part of the trust department of First Chicago, and this was all on behalf of pension funds, General Motors on down, and so that went well through the late 70s, but recognizing a lot more money was coming into the business in the late 70s and early 80s, and we're in Chicago, not in Silicon Valley. We had to do something to what we thought was improve our direct deal flow, and so with the permission of our clients in that fund, we started taking some of the money and investing directly with some of the GPs that we obviously knew very, very well. And for a more formal relationship, an advisory board seat, we became the lead investor. Again, the venture business, buyout business didn't exist, by the way, so this was 100% venture then. And that launched us into looking at all the fund managers.
Right, and for many years you served on board of NEA, one of the great venture capital
about 28 years.
Now, Bond, you may not have been present in the delivery room of the venture capital industry, although 1972 is pretty early in the vicinity. But you certainly were right there at the toddler stage, and so I want to ask you to tell us what 1980 vintage Bond French would be most surprised about in terms of how the industry has developed over the last 3.5 decades.
Well, obviously the size and scale of it was unimaginable 35 years ago, and in particular the globalization of it. Today, Adams Street has investments with managers in 31 countries, 9 in Asia from Australia on up, 16 or 17 in Europe, counting Russia, Poland, Israel, Turkey, and Europe, Canada, North America, South America. We have investments in Africa, and we get the general partners together for GP outings several times a year, and we do one on the East Coast, one on the West Coast, one in London. We've done one in Singapore, and these are annual events. And it's just fascinating how, I think of Tom Friedman here in The World is Flat, how regardless of where a GP is, you know, they're really talking about the same things: how to have better deal flow, you know, how they, you know, what their associate career path is, how to allocate the carry, how to do a better annual meeting or advisory board meeting, fundraising, you know, tips, and it's amazing. Never would have guessed that 35 years ago, that somebody in South Africa and somebody in Russia and somebody in China would all be, you know, talking the same language.
Mm-hmm.
Now, 1980, you referred to that, totally different story, and it's hard to imagine. In fact, talking to my kids about it, obviously we had no email, we had no data rooms, we had no cell phones, the PC was barely invented, we certainly didn't have any desktop computers. There was no data, there were no benchmarks, we didn't have written valuation guidelines. As I said earlier, the buyout business wasn't invented yet. Independent mezzanine business didn't exist, the independent distressed debt business didn't exist. So we, you know, obviously there are no quartile rankings, you know, anything. So it was all about, you know, working with the GPs, meeting the, you know, meeting the people and developing personal relationships. So that was the most important thing, and actually remains so today, I think. So we just spent a lot of time on airplanes and breakfast, lunches, and dinners getting to know everyone, because you're entering into these very long relationships, and the trust and respect that you have with GP is critical, and trying to understand the trust and respect they have among each other is actually probably the most critical ingredient to success then and now. So.
Right. So some things don't change.
No.
Now, we've been...
My worry today is we're too data focused, because data by its definition is backward looking. Mm-hmm. And it can tell you not to do something when you should, and it can tell you to do something when you shouldn't. And so I just worry, you know, and I tell our staff this all the time, you know, put the computer down, close the laptop, and go have dinner or lunch with the people. That's the best thing you can do.
Good advice. Now, Bon, I've been covering the industry now over 15 years, and you've been in it longer than that. And we've both seen some incredible boom and busts. Fundraising in the buyout market has gone through some incredible heights, only to crash down back to earth. We've seen the same thing in venture capital. And returns have followed a similar pattern, particularly in venture capital with the internet bubble bursting back in 2000. Was that a surprise, how boom and bust it's been, and what do you see? Do you think things will smooth out in the years ahead?
Well, if you were to go with perfect hindsight, what you would have done is to have 100% of your money in buyout funds in the 80s, mm-hmm. and then 100% of your money in venture funds in the 90s, and then 100% of your money in buyout funds in the 2000s, and maybe this decade is the venture decade again, don't know. But there do seem to be cycles, and what's interesting to us, and we want some, you know, venture capital buyout balance, subclass balance in our portfolios, not only domestically but globally, because if you think of the four macro factors that impact all investments in all asset classes, like GDP growth, stock market, inflation, the level of interest rates, availability of credit, and so forth, those four factors affect venture and buyout in absolutely opposite directions. So if GDP is slow, makes no difference to the venture community, because they're inventing new companies and new industries for that matter. It does affect bigger companies, obviously. If interest rates are high, credit's tight, that obviously affects the buyout business, has no impact on the venture business. There's no debt or leverage in it, and I could go on and on. So because we can't forecast those things, and they do have such a big impact on each sector, it's important, I think, to have some balance. So it's a funny way of thinking about, you know, Bridgewater's risk parity. This is how we think of it, actually, and we started doing that a long time ago. And because we came, well, even today we have probably 35, and with directs, probably 40% of our global portfolio in venture, and people go, wow, that's really scary, really high. And for us, you know, well, geez, it was 100%. You know, we're down to 35. So anyway.
Bon, let's switch gears a bit and turn from venture more toward the advisory side of your business. Now, in 1979, you worked to establish the industry's first ever fund of funds, and Adams Street remains a giant in that area. The industry has now matured, certainly, and we're even starting to see some recent consolidation. Where do you see that heading? Is the fund of funds business running its course? Has it run its course? What do you see as the future?
Yeah, just to clarify one thing you said, I mean, I did come in 1980, 34 years ago, so my colleagues in 78 and 79 did start it, so it wasn't myself. And as long as I've been in the industry, it was so funny because when I came in 1980, I thought I was late, you know, because the PC was, you know, Microsoft was invented, Intel just, you know, was started and growing rapidly, and Genentech on the biotech side, you know, was already going, and I was just wondering, Jesus, if all the big inventions already happened, and stock market had been running up, and so I was, you know, I debated about it, whether it was too late in 1980 to join the industry. So it's all a matter of timing and perspective in that sense. To your point on the question on fund of funds, clearly there needs to be an information advantage that you have in some way, and looking back on it, there was huge information advantages that we had, you know, 30, 40 years ago. We knew the names of all the GPs. Just knowing that was, you know, because they're all no-name, even KKR and Kleiner were no-name then. Knowing when they were going to raise a fund was a huge, remember, there was no internet, no conferences, no anything. So, so that was a plus. So today information has become more commoditized. There's obviously great dissemination of information on the funds, on the names, on performance, on benchmarking. Data rooms proliferate everywhere. So we have to work even harder to have excellent research on a global scale, to have, you know, really good client service, advanced analytics, all these things. Scale, I'm getting your question about consolidation and the role of the industry, is relevant. So there are lots of institutional investors, which is our entire client base. We don't manage money for individuals, who just don't have the staffs to do all that work and that research. And it's not just the bottom-up research, but it's then constructing a portfolio on a top-down basis that manages risk. And so, as Mr. Zimmerman was talking about, it's important to think about these things in a risk-adjusted return framework. And we have lots of reports that don't just show returns, but they show it on a graph, the X and Y axis of what loss rates and success rates are, and all kinds of buckets analysis. And so that's very important. It's ironic that if you think about private equity and certainly venture, and you plot that on an efficient frontier with other asset classes, it would be, you know, far up and to the right, higher standard deviation, most illiquidity. Yet that really represents, we're not even sure what that is actually when people say that about the asset class. Is it a single company? Yes, that would have a lot of risk and volatility. Is it a single fund? That would have less, but still probably a 35% standard deviation. But if you pull together a series of funds, and it could include secondaries, it could include direct investments or co-investments in that portfolio, you actually turn that into something, particularly if it's a reasonable size, with a lot of diversification across industries, across subclasses, across geographies, where they're less correlated to each other. You turn that into something that's actually very low risk. And so you still have illiquidity risk, but you don't have risk of loss. And so in our 42 years, we've never had a fund or a client or anybody who came in at any point, even with the worst possible timing, that's ever lost money with us. Zero.
So it sounds like you still see a good future for commingled fund of funds.
Well, we do. I mean, the industry, yes and no. The industry is under a lot of pressure, actually, because of the commoditization of information. And we have limited partners now, you know, institutional investors, in other words, who have been investing in private equity for decades. And so they have their own staffs, they have a lot of experience, they have their own networks. And so for us, in many ways, this was true 30 years ago and even true today, we're often training ourselves out of a job where somebody hires us for typically 8 to 10 years, builds a portfolio for them, they get involved in their own networks, and as they scale up, then it doesn't make sense to add an extra layer of fees to their portfolio return. They can do it more directly. Now, having said that, some are still small, so more of our client base are the mid and small investors, clearly, but not entirely. So we have some gigantic sovereign wealth funds in Asia, in the Middle East, big pension funds in the US that would hire us for things they can't do on their own, like co-investments or secondaries. Or we have some big public corporate pension plans right in the middle of Silicon Valley. They don't need us, obviously, for, some of them were founded by venture there, don't need us to find, Silicon Valley-based venture funds for them, but they have very lean and mean staffs, and so they hire us to do non-US private equity investing for them. And conversely, we have clients in Japan or Australia or the UK or in the continent that can do the local investing, if you will, but have no way to screen 1,000 buyout managers in the U.S. and have no access to Silicon Valley. So
Right.
It just depends on who sits where.
So these big institutions have specialized custom needs that you can still go in and fill. Now, in 1985, you teamed up with Stan Pratt, who was at Venture Economics at the time, eventually became part of Thomson Reuters, a company I work for. And the idea was to get off the ground the industry's first benchmarking reports. And your firm also worked with the AT&T Pension Fund to develop reporting guidelines in the early 90s. Talk about how your return expectations have evolved since those early days to today.
Well, return expectations in the 80s were in the mid-20s. And forgetting the ups and downs.
And that was venture or buyout? Or?
Well, it was all venture then, but it wasn't so sophisticated. Buyout returns, as I said, in the 80s actually had higher returns on equity because they were more highly leveraged than now. And you had, again, these macro factors. You had rapidly declining interest rates in the 80s and a rising stock market. I mean, if you remember 1982 in August, T-bill rates were 14% and the Dow Jones was lower than the price of gold. It was like at 775 and gold was 800. And so when you start buying companies with a stock price that's equivalent to a Dow of 775 and you make it work with leverage that's in excess of 14 or 16%, those things, reverse themselves, you're going to have very high numbers.
Right.
So return expectations then were quite high across the board. It's not, so you have to put it in the context, again, of interest rates being very high. So you could buy a 30-year, at the peak, 1980 or 81, you could buy 30-year treasuries with 25 years of call protection at 15.25. So we had to do something significantly better than that. But today, I would say our return expectations, net of all fees, are, again, it's a twofold benchmark, both an absolute and relative one. We want to generate, again, net of all fees, including ours, 400 basis points over the public market equivalent. And clients have different public market equivalents that they want to choose, and that's fine. And, or a real return or an absolute return of 12 to 15%. Which we think is, again, consistent with what I just said. I mean, obviously today we're in a totally different environment with 1 or 2% interest rates, and of course stock market's high, so the expected return on that would now be lower.
Right. Bon, among other firsts, your firm started making secondary investments back in the mid-1980s, and you raised the first dedicated secondary fund in 1988. How surprised have you been by the growth in the secondary market?
Well, it's like anything. We just, if you will, stumbled into it. We had no idea that the fund of funds business would be as large as it was. And of course, we'd been in business, doing what's now called fund of funds for 10 years before I heard the word fund of funds. So it didn't exist in 1980, the word fund of funds, or 83 or whatever. We were just an institutional limited partner investing in funds, and we had clients. So the fund of funds word came around, I don't remember exactly when, but late 80s, early 90s. To the point on secondaries, again, when we did our first secondary in 1986, that word wasn't invented either. We just, bought out someone's interest, and I remember the exact situation there, and we didn't know what to do. I mean, we had to think about all of the GP waterfalls midstream, not, because we didn't start at the beginning, with the capital account of the investor and what they'd gotten already and what was owed, and valuing the underlying companies, which we were actually quite capable of doing because we made direct investments all the time. We still see hundreds of business plans a year make, well, I don't get off on that. But no, we started the first dedicated fund 2 years later in '86. We weren't sure if there were going to be enough people wanting to sell that it would become anything. But it turned out every year we started buying more and more things from institutions, mainly distressed sellers, both wealthy individuals that needed money for some reason, or banks and savings and loans, or insurance companies or others.
Right.
So we raised our first dedicated fund in '88 because we knew then the market was going to be big enough to sustain, an active market, and thought that it would probably grow into a reasonable size. And for the last 3 years in a row, more than $25 billion have traded in the secondary market.
Now, has that market become so efficient that the easy money days are over and it's not a great market anymore?
Well, yes and no. I mean, but it's a little bit like thinking, well, there's lots of buyers and sellers on the New York Stock Exchange every day, and so is somebody right or wrong in that? Mm-hmm. And there isn't a right or wrong in that. Everybody has different reasons, and it's even more mature and sophisticated today, and valuations, well, particularly now in the secondary market, are pretty high, and so there are people who are doing active portfolio management, or maybe they committed $500 million to a fund in '06 or '07, and they wished in hindsight they'd only committed $250. Like the manager, going to commit to them going forward, not getting out of the asset class, but they're just trying to rebalance their portfolio in some way. And so we're active. I mean, I think we saw $35 billion of secondaries for sale last year. We wrote letters of intent or put together bids on $1.5 to $2 billion of that. Last year we only bought $250 million because we were outbid all the time. The year before it was like $500 and $700 million of secondaries that we purchased. So it is somewhat lumpy that way. But in our first dedicated secondary fund, the average discount to net asset value was 70 cents. Oh, there's just no way.
You're paying 70 cents on a dollar.
Then.
Right.
Now in '08, we bought $750 million of secondaries in 2 quarters, in the fourth quarter of '08 and the first quarter of '09 during the panic. And there we were buying things at 50 cents on the dollar. Mm-hmm. But that sounds better than it was, because these were off of June financial statements. Say in November of '08, you're buying off June financial statements because September's aren't out yet. You know that the stock market's fallen, well, every day it was going down, down, down. During the whole calendar year, the S&P was down, what, 37%, the NASDAQ was down 40, and the MSCI was down 50 during the calendar year of '08. So basically we were really buying, well, you had to mark to market, and then so we did a retrospective analysis in the spring of what the 1231s were, and it turned out we were early buying at 75 cents on the dollar, because 25 points was just marking to market, and the other 25 points was for an illiquidity discount. So today it's close to par. I mean, the average is in the low 90s for good buyout funds, mm-hmm. Lower for venture.
So Bond, with our final 7 minutes or so, I want to turn to the future. And one of the big green fields out there for the buyout and venture capital industries are retail investors. Mm. And David Rubenstein, one of the co-founders of Carlyle Group, spoke here just yesterday. Really seems to be on a heartfelt mission to open the asset class to retail investors. He called it the democratization of private equity, and he hinted that there's some initiative underway at Carlyle Group that they might be talking about very soon. And he also talked about Fidelity, T. Rowe Price possibly offering private equity through 401k plans. Bond, what is your view, and what do you see as your role at Adams Street Partners in making that happen?
Yeah. I don't think, well, Private equity obviously is a very long, illiquid asset class, and so in that context, it is very well suited to endowments and to pension plans that have long duration liabilities. It doesn't fit in this context sort of academically so easily with individuals who go through all kinds of life events and so forth and so on, or changes in circumstances, and generally have shorter term horizons in terms of their needs for liquidity. Now, if you get to very, very high net worth families, that's not really as big an issue. But I don't think that it's probably likely that there's going to be a huge proliferation of retail individuals, directly in LP documents, in the Schedule A. What I think is much more likely, and to answer your question, what we're more involved with is, and you maybe refer to this with your point about T. Rowe Price and Fidelity and 401k plans, I do think there's a role for private equity and other alternatives, real estate, hedge funds, et cetera, in a portfolio for defined contribution plans. In other words, why should you have, for an endowment or a defined benefit pension plan, what you think is an optimal portfolio, and then not offer that to the defined contribution market? Mm-hmm. Well, of course, the answer is there are more fees involved, there's more illiquidity involved, you need daily pricing, and so what people are doing is sorting out those three dilemmas, because now with very low interest rates, corporations and others are realizing that a retiree can't actually accumulate with simple cash bond stock portfolio, particularly now looking forward, the amount that they need to save to retire on. And so they either can't retire, or it's not going to be a very good future in retirement. So you need to have some more wealth generating assets in there. So I do think there's going to be a big role for target date funds. So it's going to have to be in a total portfolio context, not offered as a single slice, but in a portfolio context. And a target date fund is perfect for this, a 20-30 fund, 40 fund, 20-50 fund, whatever. And the glide path to or through retirement matches perfectly the normal, natural wind down, if you will, steady wind down of a private equity portfolio. It's perfect. And you have the long horizon there, so. And we can figure out the daily pricing, actually, with simulations. Nice.
And how soon can we expect to see something concrete from Adams Street in terms of?
Well, we're already working on it, and we already have both in the U.S. and Australia clients that have already done it.
Nice.
So I think it's just going to be but it's going to take a lot of education, and it's a gradual change, but it's taking place.
How long have you been doing it? So it's kind of in the background.
Well, the Australians have been doing it since the beginning, so they've been doing it 10, 15 years.
Mm-hmm. And Adams Street, in terms of supporting them with access to private equity?
That long.
That long, okay. All right, we've got about 2.5 minutes left, so this is going to have to be quick, but I do really want to hear from you, Bond. 3 top predictions for the next 30 years of the private equity market.
Of course, that's a ridiculous question, but...
Of course.
No, I would say before you ask the prior question, I would think the nature of the source of money coming into the private industry is going to shift from DB plans, which have been the biggest source forever, and endowments, obviously, to more DC and target date funds as a source as well. So that would be one. Mm-hmm. The other would be, and this is already underway as well, so maybe it's not a heroic prediction, but the complete electronic standardization of all things. So standardized templates for capital calls, for distributions, for reporting, for your capital accounts, benchmarking, data rooms, all that. I mean, there's lots of efforts underway there. Valuation guidelines globally, which are still not quite the same. Mm-hmm. Close, very close, but not quite the same everywhere. So that's highly likely. Again, making things less expensive, taking some of the sand out of the gears in terms of the efficiency and cost of being in the asset class. And then finally, the continued globalization of it. So one kind of tip of the iceberg, which people may not be aware of, to pick Africa as a continent, where we have a couple of managers. We've done a complete, we've been doing this for a while, but survey, there's, you know, how many managers, venture capital, private equity managers do you think there are in Africa? 110. Now, a lot of them are one-man bands, so if you take that out, there are probably 40 that are somewhat institutional. And of course you don't need 40, but there's at least a dozen now that are on fund 2, 3, or 4, actually, and have real track records. So who would have thunk it? But that's going to continue to, this is just sub-Saharan Africa, actually. South Africa, West Africa, East Africa, and so forth. So GDP growth rates there are obviously greater than most places, even greater than China. I think in the last 5 years, 7 of the fastest growing countries in the world were in Africa, et cetera. So it's going to be different.
Okay, well, I think we'll end up in Africa. And please join me in thanking Bond for sharing his thoughts this morning with us.